Nilesh Shah is with us now. He's, of course, our market master of the day, managing director at Kotak Mahindra Asset Management Company. Nilesh bhai, good morning. Great to have you with us here. Prashant this side. Thanks for joining in. You know, markets have been doing so well. So let me just take a slightly, not contrarian view, but you know, we get the first indication of what the government and what they want to do when the budget is presented, right? That will give us a sense, because the budget is now, because taxation, etc., largely is out of it. It has also become like a vision document, and this is the first of the next 5 years, so it will give us a sense of the roadmap in that sense. What, you know, is it going to be how critical is it going to be? Because the market and the way it has reacted, there was a 1 day of pain when there was uncertainty, and after that it's just really taken off across the board. So in that sense, in terms of validating the market move, how critical is it going to be? Because if you look at earnings, etc., it's got a direct correlation. I think we are now much more dependent on top-line growth as opposed to margin expansion, because the story of margin expansion is played out in FY24. And now top-line growth has got to come back, and that ties in with government policy, etc., etc. So just wanted to start there, Nilesh bhai. Go on. I think we lost the line. I think, okay, we can hear him. Go on, Nilesh bhai. We couldn't hear you. Go on. Okay, I think we'll have to dial that. In any case, that line is bad, so we can't hear him very clearly. So we'll have him back with us in just a bit from now. In the meantime, let me just take a quick look at a few other names. Piramal Enterprises is another. Just wanted to add one more name in the mix along with what Reema mentioned earlier. It's up 3.5%. Piramal Enterprises, 910. So that's a large mover. I mean, names like Sharda Motor, for example. I mean, you know, it's up 8%. And the only reason I'm mentioning that is because of volumes. It doesn't ever figure in the top gainers list at 915, but it is right now. 361, the wealth management firm, 6%. It's got very large volumes coming through. So that's some of what is moving. But I think we have Nilesh back with us. Nilesh bhai, go on if you can hear me. If you heard my question, please.
And I heard your question. Today, market is pricing in continuity of government and continuity of reforms. From that point of view, budget becomes critical. Ideally, market would like vote on account to continue with some amount of direction towards policy making for next 5 years. And most importantly, in the vote on account, the government achieved fiscal prudence despite election looming ahead and continued focus on infrastructure investment. They have got about 1,23,000 crore additional from RBI dividend. And with that extra money, they can continue in the same direction of fiscal prudence, infrastructure investment, and yet achieve certain obligations of coalition politics. So markets will be looking forward to the budget in terms of policy making for next 5 years. And as you very correctly mentioned, now for Indian equity market, margin expansion story is over. Valuations, we are already trading at a premium to other countries, other peers. And hence, it will be all about governance and earnings growth. In both those two things, we can't disappoint. In a lighter vein, Prashant bhai, Indian equity investors and Indian T20 spectators are the same. They have seen a fabulous play by their team or market. But now competition is becoming tougher and will continue to maintain the same form. If we maintain the same form, undoubtedly, we will win. Same way in market, we will require earnings growth of 15 to 20% and comfort on the governance side, where we are managing fiscal prudence along with investments and taking care of coalition dharma. If we can achieve that trinity, I think market is still in good shape.
Got that. Nilesh, hi, good morning. Always great speaking to you on the channel. You know, suddenly we've seen banks come back in a big way, right? Is there any reason for this? I mean, as we speak, ICICI Bank has hit a fresh high, and there's so much money that's flowing into the banking sector as well. What could be the main reason for this, and how are you approaching this space?
So we have been bullish on private banks for a while. It didn't work for some time because flows were not coming and market was ignoring valuation. But look at now from a comparative point of view. Banks are trading at historically lower valuation Businesses are still in good shape with deposit and credit in lower double digits. NPAs are fully provided for. And yesterday we were at 180th AGM of Bombay Chamber of Commerce, where RBI Governor Mr. Shaktikanta Das mentioned that we are very, very sure about the growth of 7.2% for next year, for this year. That growth can only happen if finance is provided for. So there is reasonable surety about growth in banking business going forward. Valuations are in your favor. Businesses are doing well. NPA worries are not there. It was just waiting to happen. And now, fortunately, market is looking at valuation and adding to private bank portfolio. One trigger, and this could be potential trigger, is MSCI's revision of one of the leading private sector banks' weight. They had included it at 50% weight. It can go to 100% in September 24 revision. If that happens, there will be buying of about $4 to $5 billion by passive funds, and hopefully even some more by active funds. So today, fundamentals and flows both are staked in favor of private sector banks.
Nilesh, morning. This is Reema here. We've seen a notable pickup in the promoter and the funds cashing out or selling stake in the markets, people who are in the know of the business. So when you speak to the corporates or funds, what's driving these exits, this sort of exodus? And two, should retail investors be a bit worried?
So undoubtedly, when you're buying for promoters, Reema, you have to be careful. They know what their business is doing. In terms of private equity, the exit happens because they had invested long time ago. Their funds are maturing. And if they don't sell in today's red hot market, what will be a better time to sell? So private equity selling is understandable based on their holding period, based on their fund maturity coming up. On the promoter selling, we have seen interesting things. In many companies, the second generation of promoter is not interested in running business, or they want to diversify away from the parent's business. They need capital to run those businesses, and hence some promoter encashment is happening. Second, in some cases, promoters are also realizing that they need to diversify their wealth. It's concentrated in just one segment of industry. There is technological disruption coming. While going is good right now, who knows about the future? And hence, they are probably diversifying their risk. It's not that they are worried about the business, but they just want diversification. In few cases, promoters are probably tempted by the valuation market is giving, and they think it's time to offload something which is going at such an expensive valuation. The third category is where one has to be careful. You are playing against someone who knows inside out value of his or her business, and one has to be careful. But all promoter selling is not necessarily bad. There may be real reasons behind it. And as a professional fund manager, we'll have to identify the reasons. If promoter is selling because he believes the businesses have become expensive and he's getting far more than fair value, then one has to be cautious.
Nilesh, the other big sort of milestone which is lined up in front of us this week is finally, how many years we've spoken about it, right? Inclusion of India bonds in global indices, bond indices, starts in a phased manner from this Friday with a 1% weight in the JP Morgan index and goes up to 10%, which is the maximum permissible limit. What does it mean from us? Not immediately. Some have been suggesting that there is already a fair bit of pre-positioning which has happened. Out of the $25 to $30 billion which was expected, since the announcement last September, a lot of money has come in, so maybe it could be in relation to that. But beyond the near term, what are your expectations? Will it really, you think, put a ceiling on cost of capital, put a ceiling on interest rates on a durable basis? Your sense?
So Prashant, when equity foreign investors came to our market, we transited from a Wild West to what is today's mature, developed, well-regulated market. In the 90s, we did witness a big scam, and regulator did take action. But the discipline of the market in terms of valuing governance, in terms of avoiding unscrupulous promoters, all those things came, when foreign investors came in. Fortunately, in our debt market, it is already well regulated and well developed. So we really don't see too much impact coming from foreigners' participation in debt market from a regulation point of view. But what we look forward is towards deepening of our market. These investors are sophisticated investors. They are using derivatives. They know how to price risk. And hence, their participation will help in deepening our market in terms of new product launches. Second, in debt market, generally we see one-way trend. Either liquidity is high in domestic market and everyone is buyer, or liquidity is negative and everyone is seller. There is very limited contra trade. With foreigners coming in, they can provide contra trade to our market. They can be buyer when everyone else is a seller and vice versa. And third and the final thing which this debt index inclusion can happen is essentially globalizing India's debt market. Today, we don't have a sovereign yield curve in dollar market. And many a times you need a sovereign yield curve to price other credit risks. By inclusion of India's index, by inclusion of India in debt index, hopefully it will lead way towards sovereign bond issuances, establishment of dollar sovereign yield curve, and fine pricing of Indian securities.
Okay, well, for now, just wanted to mention that the market is seeing some pressure. There is a bit of profit taking. The bank nifty is down about 113 points. The mid-cap index is down 118 points. And the sensex just shy of that 78,000 mark. But Nilesh, I wanted your thoughts on whether you see any kind of correction. I mean, we're not talking about a bear market here, but any kind of correction coming through, because since the end of COVID, right, this market has not seen any meaningful correction, more than a 15% correction. So at some point that has to kick in. Do you see that coming through? Is there any reason for that to kick in? And if yes, how does one approach it?
So undoubtedly, Sonia, never say never. Can market witness a correction? Answer is undoubtedly yes. The trigger for that will be some of the event going against expectations of the market. For example, market is discounting low double-digit earnings growth. As long as it comes through, corrections are unlikely to happen. And even if it happens, it will be shallow. But what if earnings growth trajectory comes down? Margin expansion story, as Prashant mentioned, is over. If volume growth doesn't come through, then certainly earnings growth could be in trouble. And then there could be correction in the market. Similarly, market is assuming continuity of government, continuity of reforms push, and the momentum of economic growth continuing, which ultimately translates into earnings growth. Any change in that expectation, any event which can lead to change in that expectation, undoubtedly will create its own correction in the market. As I mentioned earlier, because the team has played so well, we are expecting that India will go and thrash England in the semi-final. But the players still will have to play. Either Rohit Sharma has to go and knock out English bowlers or someone else. Some bowlers will have to bowl like Kuldeep Yadav. So market has done well, but we still need to ensure that players play in terms of earnings growth and governance.
You know, what could come as a bouncer, Nilesh, this time is the fear in the budget about some clamp down on F&O, because clearly SEBI, the government, they're worried about the kind of trades taking place in the derivatives market. Have you picked up anything on that front? What could be the nature, if at all, and how will the market react?
So clearly our markets are liquid thanks to very deep F&O market. But in some sense, that deep F&O market is more of a daily market rather than a longer-term market. Our futures trade up to 1 month, options trade more on a daily basis and then up to 1 month. The longer-term market is not really deep. So if there is any limitation on F&O participation or F&O volume, will it impact liquidity on a longer-term basis? My answer is no. Second, if you look at from a purely academic point of view, there are two players in the market, one who loses money in F&O and one who makes money on F&O. It's quite likely that people who make money on F&O are having better computing power, better algorithm, and better connectivity. And the cohort which is losing money is one which has less computing power, lower or less speedy connectivity, and who probably is not as knowledgeable. Now, should there be a level playing field whereby the cohort which is losing money, which is more likely retail Indian, they are kind of supported, and the cohort which is making money, including one famous hedge funds case we are hearing, they should pay higher tax, or their ability to make money is restricted a little bit. I think if that happens, overall it is good for the market. Traders may become investors. Traders may not lose as much money, which will be good for India.
Nilesh, great conversation. Thank you very much for joining us this Wednesday morning.